Private credit has gone from a niche corner of finance to one of the most talked about sectors in global markets. For years, it quietly expanded in the background, while traditional banking tightened after the 2008 financial crisis. Today, however, it represents a multi-trillion-dollar industry that has captured the attention of economists, regulators, and investors. The growing concern is simple but serious. Could this rapidly expanding and largely opaque market be the next trigger for a global financial crisis? The reason this question matters is that financial crises rarely emerge from obvious places. Instead, they tend to develop in areas that appear stable, profitable, and well-functioning, until suddenly they are not. Private credit fits that description in many ways. It offers high returns, attracts institutional capital, and operates outside traditional banking regulation. But beneath that attractive surface lies complexity, limited transparency, and increasing leverage. These factors have led some experts to warn that risks may be building beneath the surface of the global financial system. Private credit refers to loans made by non-bank financial institutions directly to companies. Unlike traditional loans that come from banks or are traded in public markets like bonds, private credit loans are negotiated privately between lenders and borrowers. These loans are typically held until maturity rather than traded, which makes them less liquid and less visible to the public. Private credit includes a wide range of lending structures such as senior secured loans, mezzanine debt, and direct lending. These loans are often provided to mid-sized companies, private equity-backed firms, or businesses that may not have easy access to traditional financing. Because these borrowers are often riskier than blue-chip corporations, private lenders charge higher interest rates, which results in attractive returns for investors. However, those higher returns come with higher risk. Private credit loans are less transparent than public bonds, and their true value can be difficult to assess. Many of these loans are valued using internal models rather than market prices, meaning that the reported value may not reflect actual market conditions. This lack of transparency is one of the key concerns among analysts today. The rapid growth of private credit is closely tied to changes in the global financial system following the 2008 financial crisis. After the collapse of major financial institutions, regulators imposed stricter rules on banks to prevent excessive risk-taking. These regulations limited how much risk banks could take and reduced their willingness to lend to certain types of borrowers. As banks pulled back, private credit funds stepped in to fill the gap. At the same time, global interest rates remained low for an extended period, pushing investors to search for higher yields. Private credit became an attractive option because it offered significantly higher returns compared to traditional fixed-income assets like government bonds. Another factor driving growth is the increasing involvement of institutional investors such as pension funds, insurance companies, and sovereign wealth funds. These large investors allocate significant capital to private credit in search of stable long-term returns. In recent years, even retail investors have begun gaining access to private credit through new investment vehicles, expanding the market even further. As a result, private credit has grown into a massive industry worth trillions of dollars globally. But with rapid growth often comes increased risk, especially when expansion outpaces regulation and transparency. One of the biggest concerns about private credit is its lack of transparency. Unlike public markets, where prices and financial data are readily available, private credit operates behind closed doors. Investors rely on periodic reports from fund managers, which may not fully reflect current risks. This creates uncertainty about the true health of the loans and the borrowers behind them. Another major issue is leverage. Many companies that rely on private credit are already highly leveraged, meaning they carry significant debt relative to their earnings. If economic conditions worsen, such as rising interest rates or slowing growth, these companies may struggle to make their payments. This increases the risk of defaults, which can lead to losses for lenders. Liquidity is also a key concern. Private credit investments are typically long-term and illiquid, meaning they cannot be easily sold. However, some investment funds offer investors the ability to withdraw capital periodically. This creates a mismatch. Investors may want liquidity, but the underlying loans cannot be quickly converted into cash. In times of stress, this mismatch can lead to serious problems. If many investors attempt to withdraw their money at the same time, funds may be forced to sell assets at discounted prices or restrict withdrawals altogether. This is known as a liquidity squeeze, and it can amplify financial instability. Recent developments have raised concerns that stress may already be building within the private credit market. Rising interest rates have increased borrowing costs for companies, making it more difficult for them to service their debt. At the same time, economic uncertainty has made it harder for businesses to generate stable earnings. As a result, default rates in certain segments of private credit have begun to rise. Some funds have reported losses, while others have taken steps to limit withdrawals from investors. These actions suggest that liquidity conditions are tightening. Another warning sign is the growing attention from analysts and economists who specialize in financial crises. Some experts have pointed out similarities between current conditions in private credit and earlier warning signs seen before past financial crises. While these comparisons are not definitive, they highlight the need for caution. Additionally, global factors such as geopolitical tensions, energy price shocks, and inflation have added pressure to both borrowers and lenders. These external forces can weaken financial stability and increase the likelihood of stress spreading across markets. The key question is whether private credit alone could trigger a global financial crisis. The answer is not straightforward. While private credit is large and growing, it is still smaller than the traditional banking system and is not as deeply integrated into the core financial infrastructure. However, the risk lies in interconnectedness. Private credit is linked to other parts of the financial system, including banks, institutional investors, and capital markets. If losses in private credit were to become severe, they could spread to other areas through these connections. For example, if private credit funds experience significant losses, institutional investors such as pension funds may see their returns decline. This could lead to broader financial stress, especially if these institutions are heavily exposed to private credit. In extreme cases, forced selling of assets could impact public markets, leading to wider financial instability. Another concern is confidence. Financial systems rely heavily on trust. If investors lose confidence in private credit, it could trigger withdrawals, sell-offs, and liquidity shortages. This kind of panic can spread quickly and have far-reaching consequences. Many analysts compare private credit today to the subprime mortgage market before the 2008 financial crisis. In both cases, there is rapid growth, high returns, and limited transparency. However, there are also important differences. The 2008 crisis was driven by complex financial instruments tied to mortgages, which were widely distributed across the global financial system. When the housing market collapsed, these instruments lost value, leading to massive losses across banks and institutions. Private credit, on the other hand, involves more direct lending relationships. The loans are generally simpler and less interconnected than mortgage-backed securities. This reduces the likelihood of a sudden, system-wide collapse. However, simplicity does not eliminate risk. If economic conditions worsen significantly, private credit could still experience substantial losses. While it may not trigger a crisis on the same scale as 2008, it could still contribute to financial instability. Despite the risks, many experts believe that a full-scale global crash caused by private credit is unlikely. One reason is that the market is still relatively contained compared to the global financial system as a whole. Another reason is that private credit is designed with risk in mind. Lenders often require collateral, impose covenants, and structure loans in ways that reduce the likelihood of catastrophic losses. While these measures are not foolproof, they provide a level of protection. Additionally, many private credit managers are experienced professionals who actively manage risk. They monitor borrowers closely and adjust their strategies based on market conditions. This active management can help prevent small problems from turning into larger crises. Finally, regulators are increasingly paying attention to private credit. While the sector is less regulated than traditional banking, oversight is gradually increasing, which may help reduce systemic risk over time. For investors, private credit represents both an opportunity and a risk. The high returns are attractive, but they come with exposure to illiquidity, opacity, and economic cycles. Investors who allocate capital to this sector need to understand that it is not risk-free. Diversification is essential. Relying too heavily on any single asset class, especially one with limited transparency, can increase vulnerability. Investors should also be aware of liquidity constraints and ensure that they have sufficient access to liquid assets. Understanding the economic environment is equally important. Private credit performs differently depending on interest rates, inflation, and overall economic growth. Rising rates and slowing growth can increase default risks, while stable conditions may support performance. The question of whether private credit will crash the global economy does not have a simple answer. While the sector carries real risks such as opacity, leverage, and liquidity mismatches, it is not inherently unstable enough to guarantee a global collapse. Instead, private credit should be viewed as a potential amplifier of risk rather than a primary cause of crisis. In a strong economic environment, it can function effectively and provide valuable financing. In a weak or unstable environment, however, its vulnerabilities could become more visible and contribute to broader financial stress. Ultimately, the future of private credit depends on how economic conditions evolve, how investors behave, and how effectively risks are managed. It is not a ticking time bomb, but it is certainly a sector that deserves close attention. In the world of finance, the biggest dangers are often not the ones that announce themselves loudly, but the ones that grow quietly in the background. Subscribe now and stay ahead of the biggest financial shifts before everyone else reacts.